Hello. Hello, everyone. How are we doing? Good? Exciting times in DeFi. I think this panel is more relevant than any time in the history of DeFi. We've got really great panelists and would love for them to introduce themselves before we kind of delve into financial risk in DeFi.
Yeah, sure. Sebastian, co-founder of Steakhouse Financial. We are providing earned product for stablecoins and the whole DeFi. We are creating on Morpho, Camino, and also managing the growth sub-DAO of Sky.
Yeah, I'm monetsupply head of strategy at Spark. We're one of the largest on-chain capital allocators in DeFi within the Sky ecosystem.
Hey everyone, I'm Matt, working with Allez Labs. We're a risk and data firm working with protocols, primarily lending protocols across SVM, EVM, and all sorts of exciting chains.
Yeah, hey, Yaron from B.Protocol, also risk DAO. Over the last few years, we are consulting lending markets, and now also curating vaults on Morpho and a bit also on Euler.
Hello, I'm Rémi. So I have two hats. I'm the co-founder of Lagoon.finance, which is a permissionless vault infrastructure for curators or asset managers, and also a co-founder of 9 Summits, which is an asset manager and curator on Morpho, Euler, and Silo.
Fantastic. So we've got like asset managers and lending protocols and like almost the risk assessment tools, and we've got it all, I think. So I'm sure you know that the October 10th crash of crypto has brought a lot of like contagion that spread across DeFi, and that brought down some projects. And now the debate is about basically risk in like in DeFi. Well, who's managing risk? So I think probably the question to everyone in the panel is this shift in DeFi risk, the risk landscape. How do you see it in 2025?
Yeah, I can take this one. I think people learn that when you go on something called high yield, and there is a higher yield, there is risk. So sadly, it's sad that we have to learn it this way. But yeah, I think people now realize that chasing the highest yield is not always the best option. And I hope that people will start to thinking more about the risk side on the risk-return profile.
Yeah, I think that's a great point, and it's also it's getting more challenging for people to assess risk because previously there was maybe a few lending markets, like you work with Maker, you work with Aave, you work with Compound. Now there's even dozens of risk curators. They all have different approaches, different methods of risk management. So the job of a user is getting a bit more demanding, and I think we haven't really caught up with giving them the information they need in a digestible format.
Yeah, one of the really nice things about DeFi in 2025 is that unlike in previous years where, as Monet just mentioned, there's just a few opportunities for users to kind of dive into DeFi. Now there's a lot of different opportunities, whether they're different vaults with different kind of risk and reward opportunities there. And the challenge really is making sure that nobody's taking on much more risk than they intend to for the given yield. So kind of making sure that the risk and the reward stays balanced. It's something I think the ecosystem as a whole has a lot of room to improve in kind of helping users figure out where to place themselves on that spectrum.
Yeah, so definitely Morpho, then also Euler and others introduced, like a new concept of risk curators and kind of delegating risk management to others, maybe also to the users to some extent. Specifically in the last year or so, ever since Etsina, we saw that most of the yield actually moved off-chain. So a lot of off-chain components were introduced, arguably with higher risk, but with the way on-chain things are going, it's also kind of debatable. Where eventually most of the risk is. Other than that, I think, like the trend maybe of 26 will be not only risk curator, but actual, like fund managers in the kind of flavor of Midas and others, which, never really existed until now.
I think what we've noticed in the last 2 years is the externalization of risk, especially in lending protocols. So there is now like 2 models. model where the DAO or protocol would handle the risk. And the model introduced by Morpho 2 years ago were the externalization of the risk to curators or risk manager, asset manager, whatever name you want to call them. So I think it's interesting to see how, maybe for user now, there is they have to make a choice for the protocol and also for their curator. So it's becoming more complex to assess a situation and to look at the risk. And when you allocate to anything on chain, it's you have to know your curator very well, I would think.
And I think probably in 2025, we've seen the rise of these yield-bearing stable coins and basically underlying, tokenized strategies. And all of a sudden, I think 2025, people have stopped asking, like, well, how do these assets work? Like, are they permissioned? Are they permissionless? Back in the day, I remember like 2 or 3 years ago, everyone said like, well, the maker's DAI was just permissionless, you could redeem it, and all of a sudden today in 2025, just recently people discovered, well, I'm trying to redeem this stable coin for the USDC, but there isn't any. Where did it go? So I think a lot of these questions probably we'll try to answer in this panel, but honestly, like for just the average DeFi user or really the asset manager, the question is always like, what is the risk surface in DeFi? Probably like, Sebastian, you allocate a lot of capital in DeFi. What are we looking at exactly? What's the risk surface? If you can break it down to us.
Yeah, so Steakhouse is involved in orienting up to $3 billion of capital, so that's a lot. And the risk is very different depending on what you do. We are allocating, for instance, in T-bills. I know in DeFi, a lot of people are saying, well, T-bills, those are risky, those are not liquid. T-bills are, or government money market fund are the risk-free yield of TradFi at least. And now it's coming on DeFi. So that's quite easy. It's not instant liquidity, but you really have it the next day, so that's fine. Then you have the lending protocol. So here you need to understand what is the collateral. And obviously, depending on the collateral, you can have crypto collaterals, you can have hedge funds, you can have a yield-bearing stablecoin, and you need to understand where the yield is coming from. And for those hedge fund strategies, like stream finance, well, you need to understand how they are generating the return. Because if you don't understand how they are generating the return, you cannot understand what are the risks. And it's very simple. If you don't understand, don't touch it. I think that's still a rule that works.
But then users might withdraw from the vault because you don't have competitive yield, and all of a sudden everyone in DeFi is generating 80% and you're generating 12%. So maybe I ask Rémi, you also allocate a lot of capital. And what do you do for example, when your vaults like underperform in comparison because now you're taking less risk, for example? How do you manage this?
So you need courage to give user a lower yield, knowing that you handle the risk correctly and allocate to the right collaterals and the right asset. So I think a lot of yield-bearing stablecoin are in fact just vaults with asset managers allocating a stablecoin on chain or off chain sometimes. So what should be the industry standard is when it's allocated on chain that you disclose all the addresses where so user can track what you're doing and the transparency that go with it. So it's very, and when I go to different protocol, for me sometimes it's hard to just find the final address where the money is allocated, to find the Octave or the debunk bundle link with all the addresses. And sometimes the money is even allocated off-chain, so then you cannot track anything transparently, or you have to rely on attestation. So sometimes it's fine. For example, like Etina has off-chain allocation, and so if you trust the team, if you trust operational risks that they carry, it's maybe fine to allocate, but you have to bear in mind that there is no instant transparency on what they're doing, so there is still a risk, but when there is yield, there is always risk, so it's just a matter of finding the right balance as an on-chain allocator.
Yaron, would you like to add anything to?
Yeah, nothing much to add. No, I mean, like the reason was like obvious competition, you know, like over yield. I think eventually not everyone went full degen. But by the way, even those who didn't went full degen might got hit, you know, regardless. Like the competition was very obvious, but also you could see some emergence of, you know, like branding and, you know, so like there was this feeling that maybe users don't know anything, but eventually most of the TVL did go to, you know, like more recognized brands, even to something like Aave, which, you know, by far has the most TVL. So, you know, like saying that users don't understand anything is not correctly true, but yeah, there are like many users who might not really fully understand.
Mone, I have a question. So Spark, you've one of the leading lending protocols. I think you've also always questioned or like consider whitelisting assets, and you know, and now with this new wave of DeFi, and how do you assess risk in general before like deciding to either considering an asset, or if maybe the community asking you like, hey, why can this asset be the borrow in the pool? How do you look at risk?
Yeah, we get an incredible amount of inbounds. There's, you know, an explosion of different issuers. A lot of them have interesting strategies, but the transparency is often a bit lacking. So I think that's kind of like a threshold issue for us. Like if we can't get like good transparency into how your strategy works, we have no idea what the sort of like dependency graph looks like. You know, as an example, the DEUSD stablecoin, I think people assumed initially it was just, you know, cash equivalents and then basis trade, but then suddenly they were allocating into a bunch of different stuff, and if you don't have that transparency aspect, you're not going to find out about that until too late. So I think that's a really important threshold issue, but then just trying to like look through each of these strategies, each of these tokenized like hedge funds to see what they're doing and making sure that you're comfortable with each component. So it's quite a bit of legwork, but you know, I think maintaining that discipline is really important, and it doesn't pay off immediately, but over time, this is how you build user trust, and you know, basically just making sure that you're doing everything right and being patient.
Yeah. So obviously, risk has become significantly serious in today's DeFi, with all these assets and all these and off-chain operations as well, and probably no one has any purview over them. And so now the question is, well, who's responsible for managing risk? We've got here like some, of course, like the risk managers. By the way, it's a confusing terminology, like, you know, because I don't know, do vault managers or asset managers actually manage risk? Is it part of the responsibility? So probably the question is, who's responsible for managing risk on behalf of users or even the LPs or whatever? So maybe, you know, Seb, you can.
Yeah, sure. So there is a strong question to be asked if curators are managing risk and in which way they are responsible if something goes bad. I think it's a fair question, and the industry didn't decide exactly yet. When we are creating a vault, we are creating something with a specific risk appetite. It doesn't mean that we are saying it's risk-free or anything like that. It's just that we are targeting a risk appetite because we are assuming that some people want to have such a risk appetite. It doesn't mean we are comfortable with the risk appetite. Obviously, we don't have the riskiest vault because I want to be able to sleep at night. That's my threshold. But for instance, I always say, and I said it publicly on Twitter many times, for most people, they should only use our prime product, not the high yield one. Now, when we created the high yield one, we didn't have it at the start. Before they were live, most of people in my company were asking me how they can get access to the product before it's live. So that shows you that people are always a bit degenerate, and actually most of the treasury, most of the Steakhouse treasury is in those high-yield products. So it's difficult to have a clear answer. I would say the fact that the curator is investing in their own product is showing that they are comfortable with the risk, but doesn't mean that it's a good risk for you. You need to ask yourself first, what is the risk you are comfortable with?
I think that's a really good point, and I think a lot of users maybe are not honest with themselves of what is their actual risk appetite. They want high yield, but they're not comfortable with like, you know, occasional charge-offs or decline in value of the strategy. So that's an important thing that, in a sense, users are partly responsible for managing their own risk.
Matt, you also allocate capital. You also have access to lots and lots. You have your own risk assessment tools, and you have, so whose responsibility is it, and what do you think that people like you can do more for the users to understand risk?
Yeah, so I think that, you know, as we all have kind of been talking about, there's even the same, you know, curator might have a variety of vaults with different risk levels. And it's really not something that the industry has really figured out how to actually communicate what these risks are and quantify them. So although it's very easy to look at either the instantaneous yield of a vault or a market and, you know, or historical yields for that matter, it's a little bit more difficult to communicate these risks. And there's several risks, right? There's liquidity risks. You know, are you going to be able to withdraw all your assets at the click of a button whenever you want? There's also, you know, some sort of charge-off risk or insolvency risk in these protocols too. And I think, you know, even if you're investing in, you know, a bond fund or something like that, if you're kind of, you know, more on the high yield side, just in traditional finance, right? There's going to be some insolvencies potentially in there, and that's just the cost of business. It's not necessarily a horrible thing. And I think that something that a lot of us, you know, are working on now is kind of how can we better communicate that to users so they can pick, so they can choose by themselves. As we saw the other day, you know, there was, you know, high utilization in a lot of vaults and a lot of markets. If a user is not comfortable with that, you know, maybe needing to wait 12 hours to withdraw their liquidity, that's something that they absolutely should consider before entering some of these positions. And it's not really something I think most of these same people that were, you know, a little upset about it had thought about prior. So I think, you know, kind of better illustrating all of these risks and, you know, helping users figure out which they're comfortable with is really important, something that we're all trying to work on.
There seems to, right now the debate is, well, what about governance? What about like, you know, protocols governance, managing risk? There's other thought about well, hiring professional services. Like, of course, there's a lot of them, and some DAOs already work with them. So maybe the question to Yaron, how do you see this playing out in DeFi governance, token holders versus teams hiring, like, you know, professional services?
Yeah, I think eventually, you know, like the vision we had is that at the end of the day, you'll have community or token holders that will kind of have to decide on the level on the risk, while you'll have professionals that will have to report, you know, like the risk level. I think it's perfectly fine for certain communities, you know, to decide they want maybe a risk that is twice as much as other, you know, for others to be more conservatives. And yeah, it might not be realistic, you know, to expect token holders to fully understand the risk, but once the risk is reported by professionals, I think it's eventually up to the community to decide, you know, whether today they want higher or lower risk level than yesterday.
Yeah, and when you look about risk and who manages it, there is also a question, so whether it's service provider of a DAO or externalization of risks through Curator, there is a last responsibility of the protocol to actually how the data is shown and what are the options for end user on the front end. So for example, in many lending protocol, being a curator is permissionless, so anyone could do it. But ultimately, the responsibility of the protocol itself to list it on the main front end. So protocols still have to do curation of curator in the end, a little bit, or at least like KYC them or make a few, see that they operate correctly. So there is a little segmentation about who will show what the user have access to in the end.
I think DeFi today is just for really the degen, the individual who's willing to take massive, massive risks. And obviously, a lot of users just do not do their due diligence, and probably sometimes because the tools do not exist or maybe very hard to actually find. And sometimes like information is very difficult. So who knew like a certain oracle was controlled by a centralized entity, for example, or like you could not redeem this, redeem that. But I think that's probably the responsibility of entire DeFi. If we want to see DeFi expand, want to get like the millions and probably like hundreds of millions of users using it, you can't tell someone crossing from TradFi that, well, sorry, like you know, someone ran away with your money because of this, or they lost on a centralized exchange. And now kind of bring me to the Stream case, like Stream Finance and Elixir recently. I think that's probably like the consequence of the crash, October crash, lost money and thousands of users. Like I personally deal with this every day. I'm trying to help users with the users of Silo Finance recover their funds. That's our #1 top priority because, and now maybe someone can walk us through what happened exactly, like why Stream and Elixir like both kind of like the, you know.
Maybe I can pop in a little bit. I've looked into this Stream situation recently, but Stream was doing a few things that kind of amplified the risk of their strategy and had it created contagion essentially with other related products. So first of all, they were delegating or investing their user funds fully off-chain in a very non-transparent manner. They've disclosed that they lost 93 million in one of their strategies, but it's still actually not disclosed who was running the strategy. What was the strategy? I've heard some people say that it was like a volatility selling or like some sort of option strategy, which is, it's not the typical, you know, sort of delta neutral strategy that people might be expecting from one of these off-chain assets. The other thing they were doing though is they were minting their own token and then posting it as collateral across various lending markets to essentially draw in like leveraged capital, not people who are intending to invest into XUSD, but just people in various different vaults across the space. And there was a bit of like sort of cross-contamination between XUSD and DEUSD and various other funds that were kind of mutually investing into each other. So all of that means that, you know, when they lose a certain amount of money, the sort of flow of losses spreads very wide, and it also gets levered up. So yeah, there was many different things that were kind of wrong with Stream and created a lot of challenges that people didn't expect to happen.
And until recently, until probably like a few weeks ago, no one talked about this. Why did DeFi fail to spot those like red flags?
So actually, someone talked about it on Twitter and gave some warning 2 weeks before CBB. So it's a good idea when someone gives some thought about a project to just withdraw everything and assess later, as he said. So there were a few people, also Togby and other, like, so just pointing finger at, when you looked at the detail of the strategy, it was a big leverage, crazy health factor across the board, but that was only for the transparent part. What I didn't know is also that they were allocating off-chain. And yeah, to me, the story doesn't make any sense. We allocated to an external manager, and he lost 100% of $93 million. I think there is more to be learned about this story than just what we know just now. And yeah, just looking back at, so I actually met those people in real life in April. And there were young people doing crazy degen, and I was like, am I getting old in DeFi? Am I doing very, very conservative grandfather strategies? Is this the new DeFi? And I was like, okay, this is not for me. But yeah, it's crazy how things turn out. But yeah, if there is a FUD on something, it's better to just withdraw and assess later.
Yeah, I mean,
I was just going to say, I think the idea that no one spotted this is also not quite correct. I think that a lot of people, right, would see this and maybe they're asked to allocate, you know, some of their vault to this product or invest in it. There's a million things, right? But I think, you know, when you kind of see a lot of these assets come, you know, through your desk, as they say, right, a lot of them are not a good fit, and that doesn't mean you necessarily have to write like a big tweet thread about how this is a bad asset or something. I think the standard process is just to say like, hey, this asset's not for me, and move on, because there still are a ton of assets that are allocating user funds more or less off chain, and they're not particularly assets that I want to deal with, right? But there's still some out there. I'm not saying there's like more assets like this that are going to have a huge contagion and cause as much excitement, but just because no one kind of like wrote a blog post on it, I think people did see it. It's just
it's very hard to say no to high yield. Extremely hard, especially if others are shilling high yield on Twitter. You just feel like you're missing out. So a lot of users do it. So Sebastian, what's your take on the situation? You haven't allocated any money to. You did not allocate any money to.
No, we didn't. So we didn't make a due diligence on Stream Finance at all, because it was just obvious. Why USD? I just sent one DM. Are you an unregulated hedge fund with a ton of leverage? Answer was yes. I would say, okay, not for me. But to your point, why isn't there so many warnings? And some people are saying on Twitter and so on, but there is some risk. But there are also some risk on other projects. And we were not, and it's just a probability game. Why did Stream Finance blow up? It could have not blew up at all. And it could have worked for 10 years or 20 years or until infinity. So if you are coding it, then you are having on crypto Twitter, you would have a lot of people fighting for you. There are other bad projects or projects that can blow up. Every time you give money to a random guy on the internet and expecting yield, you are taking a risk. And there is plenty of projects, some that are quite big. I remember with monetsupply when there was Encore, Terra Luna, we were trying to find how to short it. But we didn't say publicly that it's a bad thing, because that would be suicide on crypto Twitter. So the reality is that we cannot speak up, because we want to be friends with everyone, because even if Stream Finance was taking a lot of risk, maybe you fake it and then at some point you make it, and they would end up being a regulated stablecoin that was all fine. So you cannot cry against the wolf too early neither. So that's my take.
Looks like they faked it all the way. So recently people started asking questions about like, okay, the Oracle, why it's still $1 like in some lending protocols? Well, and then it started digging into the source. Like, how do you really read how do you value a certain asset? And then all of a sudden we discovered that, not all of us, but some people discovered that, well, it's NAV based, so net asset value based, and there was no third party to really verify how much money they held versus what's the backing of the stablecoin. So the question is, Yaron, to you, like what kind of tools, what's the minimum threshold that actually should DeFi enforce at least, and somehow on protocols to actually have at least a minimum, transparency?
Yeah, no, I think, NAV-based oracles are not necessarily pure evil. Even for StakeTis and, other assets, they're even the kind of the best practice ones. Specifically with Stream Finance and Elixir, maybe a year from now, after there might be some partial recovery, we will know if in retrospect, if it would have been better to have, like a NAV-based oracle or other. I think, it's mostly concerning and it's mostly challenging when you use it in a permissionless framework such as Morpho, maybe Euler, I don't know, rather than frameworks like Aave, where in Aave, you do have kind of the liberty to change the oracle if you want. While in Morpho, maybe technically it is possible, but already requires some coordination and, like around curators to begin with, which is not very realistic. So yeah, I'm not sure, sometimes it will be better, sometimes it will be worse, especially for low liquidity stable coins. If you use market-based pricing, we saw this incident with Moonwell on some StakeTis that use market-based pricing, and it was priced like 3,000x, higher than the real price. So yeah, like if it is possible, and this is where maybe DAOs can perform better, and you have people who can take decisions at emergency and change it, maybe it's better, but otherwise, it's part of the risk.
Yeah, and I think like, oracles are just hard in general, even if they're, crypto native assets, like even something like Bitcoin, right? To have an oracle for that, maybe that's the easiest one, right? But it's still an endeavor to kind of implement that correctly. And for some of these RWA-based tokens, even if they're treasuries, right? You're dealing with stuff that's off-chain. Maybe you're dealing with, a variety of durations, and I think there's a lot of room here for exploration. You could imagine maybe having something like third-party attestations being published on chain. All sorts of things like that I think could really bring the risk of some funny business down a bit. But I think the design space is actually pretty large here.
Well, I have a question. So I think DeFi has evolved from a place where everything has to be decentralized, permissionless, to accepting some level of centralization and some less transparency. I think we've gotten a little bit lazy, and now the recent, it seems that we've accepted too much of compromise in DeFi. What's for example, the current some of the current assets that have massive operations off-chain? How do users and protocols how can they navigate risk of such assets?
Yeah, it's a major challenge, and it's something that we sort of struggle with at Spark. So previously we've had some exposure to Athena, not any longer, but we also work with Maple. We're looking into other sort of like hybrid on-chain, off-chain products and services. I think there's a huge opportunity for like real-time attestations and making them provable. So like ZK proof, TEE, a lot of these technologies can definitely help. But I also think that part of the reason that we have so much of this off-chain assets coming in is because DeFi isn't really feature complete yet. There's people who want to do fixed rate lending, as an example. It's a huge priority for institutions, and they're willing to pay a significant premium to borrow fixed rate versus variable rate. So, in the current condition where fixed rate lending isn't really available in DeFi or on chain, of course, there's this huge incentive to work with Maple or maybe do it yourself and lend through custodians. I think Morpho V2 and kind of new infrastructure is going to solve that. And then similarly with perpetuals, we're seeing like an explosion of sort of increasingly sophisticated protocols. So in the future, you could theoretically see a world where all these delta neutral strategies are happening in a much more secure, transparent environment. And I think that's in the interim, we're probably needing to do more of this sort of verification, but I think we'll move more of the actual activity on chain in a kind of a safer environment.
Rémi, would you like to add to that?
Yeah, I think like RWA coming on chain is something that is just starting, and it's going to be huge. Back to the valuation question, I think for tokenized hedge fund, so general purpose vaults, as opposed to lending vaults, the NAV, so the valuation, is usually handled by the asset manager himself, which can be problematic. But also, when you're a hedge fund manager, you look for specialized third-party providers that compute NAV in DeFi. There's not a lot of options and service providers who are experienced and who are doing it right. So I think it's very, we're just starting, and maybe the space is going to professionalize. So this tokenized fund can have more independent third-party NAV provider that can give a real value, and ultimately that would be better for the users.
Okay. So there's no risk-free yield in DeFi. It's a myth.
T-bills.
It is. Yeah. I think like probably DeFi is under a lot of pressure. If you really want to make like 4 or 5%, a lot of users just want to use DeFi. Just go use TradFi and just you eliminate at least the smart contract risk, and it's a really quite challenging. So everyone in DeFi just wants more and more and more. So now, how do we build really just more transparent and more resilient DeFi? like what do we need? Do we need just tools? Do we need to centralize risk management with curators? What do we have? What do we need to do?
Yeah, I think transparency and explaining what, for instance, curators are doing, what is a mental model for each product is quite important. For instance, obviously what we do for Vault is fully on-chain. We have some dashboard, but you can always say, well, it's difficult to understand. We didn't publish a lot at the beginning, mainly for regulatory reasons, because when you're publishing anything, you are taking a risk. I don't write regulation, but that's how it works. So now we have published a risk framework so people can understand how we are thinking about risk, what we are analyzing, what we are adding on new collateral. We will publish a bit more thanks to the fact that now there is a more friendly regulation in the US. But I think it's mainly on disclosing, and make it simple for people to understand. For instance, it will be, and also having some counterparties that you can trust. I mean, trust is still quite important. I remember when there was a USDC that was onboarded at MakerDAO, everyone was like, we cannot trust Circle, it's off-chain. Come on, guys, now it's regulated by Genius, it's a big public company, maybe we can start to trust them. And the same people that didn't trust Circle 5 years ago are probably the one willing to give money on the internet to stream finance or YUSD people that are, who knows who they are, and they have no expertise, no regulation, nothing. So for instance, we added a Fazenara MF1 as collateral, and people are saying, oh, it's off-chain, it's complicated, there is no transparency. I mean, yes, that's correct. You have less transparency, it's more difficult to have the prospectus because you need to be accredited because there is a lot of regulation making sure you never get the right information. But it's a regulated entity that is managing 5 billion, that is doing this business for 15 years. How could it be more risky, this one, than random people on a website that you don't know who they are? So it's very simple at the end of the day. There is hints of what you can trust. If BlackRock is launching a product, no one will read the prospectus. No one will ask any question. If you see BlackRock, you will invest. But BlackRock has risky product as well. So you just need to find proxies of knowing when it's safe and when it's not safe. Lindy effect is something. It's not 100%, but it's still something to see. Steakhouse, obviously at the beginning, you could have thought, well, who are those people? We are now here for 2 years on Morpho. You might say, well, maybe we know one thing or two. And we try to be more and more transparent on how we are operating stuff. Same for everyone. But if someone new comes up and you are giving them 1 million and you don't know who they are, I mean, at some point, just, it's common sense at the end of the day.
What would you like to add?
Yeah, I think one thing that maybe people are considering more in light of the balancer hack is, although we're DeFi native, we're not comfortable with these off-chain assets where maybe we have a bit less transparency, we have to trust a counterparty. You still face some pretty large sort of 0 to 1 risks operating on chain, even for protocols that have been around for a while. So you just need to kind of weigh like the security risk, the smart contract security risk versus the counterparty risk, and it's not like necessarily always better to be fully on chain. Sometimes it's okay to trust a counterparty if they've proven themselves and they're existing within a rigorous sort of like legal and regulatory framework.
And what kind of tools do you think we need to provide? So actually, let me back off a minute. And we've talked about the responsibility, but we haven't really talked about the responsibility of users themselves. Like it's information, yes, it's difficult to kind of collect and really sometimes understand. But this is an unregulated space. It's extremely convoluted. Information is available everywhere, but then it's still the user's responsibility to do it. So why can't DeFi come up with, like, say, for example, like maybe some sort of like organization that could provide insights about this new projects coming up and kind of like flagging these and even like, giving limited access. I think Yaron has done something similar to that.
Yeah, so it might not be popular to say it in this venue, but to some extent AI, it's like a huge buzzword that everyone likes to throw. And yeah, definitely it's not perfect, but one thing that this curator thing doesn't do, it doesn't give you any personalized risk, kind of advices or management. And we say, definitely it's not perfect, but for some users, it's probably better than nothing, and it can help you maybe convey the risk more and maybe understand the risk more. Again, like not sure if it's like a legal solution, and from regulation point of view, etc. But I think at this point, it can definitely outperform many of the kind of existing DeFi users.
So I think first there is no risk-free at all. There is always some risk when there is some yield. And one of the problems that users face is there is no normalization of the way we display yield or APRs in the space. So some projects or some vaults, some hedge funds display projected APR, which doesn't make any sense. Some of them display the instant APR, which doesn't make any sense also. And some of them display 7-day moving, 30 days, 1 year, and since inception. So at least what we could do as an industry is find some kind of normalization around how to show historical yield, net yield. There is usually shares and price per share, so maybe someone could find a way to show all vaults on all products and just show how they compare to each other in a normalized way. So I think some vault aggregator already kind of are trying to do that. So it's a good first step. But I think as an industry, it would be great if we could normalize the way, at least the way we show APR. And about the risk model, it's a bit more difficult. So I know there are some risk notation agencies that are coming to DeFi. So I don't like this too much because it reminds some bad memories about the subprime crisis, where everybody would give very good ratings. There can be conflict of interest. And this notation agency can charge the curator, and because they are the one paying them, then conflict of interest. So I don't like too much the notation agency personally, but I think we could normalize APR to begin with.
Okay, now to conclude, just one last thing. I'm going to ask each of you to provide one sentence, your vision of safer DeFi.
I would say it's better product, less concentration risk. Let's just try to add safe stuff and not go chasing the highest APY, even if everyone is asking you to put the riskier collateral to have a better APY.
I would love to see much more clarity on the risk surface of each product. So as a user, you should be able to see what particular asset drops for XYZ assets that you're exposed to in this product are going to cause you to begin losing money. It's not something that exists today, but I think that'll allow users not just to look at a letter grade or a rating, but they can actually express their own risk preferences and what things they're comfortable or not comfortable with.
My sentence, or just 2 words, would be more transparency. I think that when users are depositing into a market, vault, whatever it may be, kind of better understanding what counterparty risks they're taking, as Moderator said, what qualitative risks and volatility risks they're taking. I think that's super important, and I think as the front ends currently are, I think it's a bit difficult for people to get that on first glance. The data is usually there, the information is usually there, but it requires a little bit more digging on their part.
Yeah, so transparency for sure, but one thing that may be also missing, in the kind of standard security audits, etc., is maybe also featuring complexity and not only, transparency and risk.
So I think to finish with a positive note that we talked a lot about the risk, about the dark side of DeFi, about people taking loss, but there is still some incredible opportunity for risk-adjusted return in DeFi that you don't find anywhere else. And if you want to have access to those yields, come reach out.
I think we have to go back to the days where when we used to say, verify, do not trust. I think that's the way. I think we've trusted too much. All right, that was it. Thank you so much, everyone. Give it to our panel.
Thank you very much.
Thanks.